The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So this subject is one that's probably close to everybody's heart, and that is the stock market.
Yes,
Power
indeed.
laws in the stock market. We have a unique market this time around, something that we are not really used to in recent years. Well, if we go back, I should say recent decades.
Correct.
In recent decades, the focus has been on investing across all sectors, being broadly diversified, own international, own a bunch of bonds, and all of that diversification and risk management stuff kind of collapsed. The theory just didn't hold up when COVID came along. And
Sure.
Here in America and in the West in general, we got a real serious dose of what it's like to live under a controlled economy when the government told us to stay home, we'll pay you, close the businesses down. And we said, now what do we do? And we changed our way of life and our expectations. And as the market has finally begun to recover after the 22 collapse of almost everything, we find that there is substantial concentration, and the diversification story certainly has not been as attractive as we have been led to believe it should be.
You bet. Everyone has heard at this point of the Magnificent Seven stocks, the big mega cap tech stocks that are driving the market right now, and people are starting to wonder if that's a good thing or not. Is it, how bad is it that the majority of the market moves are coming from a handful of securities out there? And should we be concerned that there are hundreds of stocks not doing quite as well as those seven? And is that a big deal or not? And it's time to take a look at it a little closer and try to decide. So is that really that unusual? And is it something that we should really be worried about? Because those big seven companies are just mind-bogglingly huge. They're huge. The average market cap of the Magnificent Seven is $1.6 trillion. And the average return this year, it's up 105% in those seven stocks. The average market cap of the rest of the S&P 500, it's around $57 billion. And it's up how much year to date? About 4%. So it's night and day different. So there's a huge concentration both in market cap size and returns so far this year in the Magnificent Seven.
Well, and you mentioned that there's a few hundred other stocks. Actually, it's thousands of stocks. There's roughly 6,000 securities on the U.S. exchanges, individual stocks. Plus, there's around 3,600 exchange traded funds, and you have all the mutual funds. So that you have seven stocks that have forced the indexes higher because they are capitalization weighted. The one index that hasn't been driven by that is the Dow, because there's only one tech stock in it. And not that there's that many industrials anymore, but it hasn't been, and it's calculated differently. So it hasn't been driven by these seven stocks. But there's a lot of other areas that have been substantially weak. The returns simply haven't been there. One of the areas that gets a lot of press as being the bargain that nobody should ignore is the value available in two specific areas. One is emerging markets, and the other is small cap U.S. stocks. But small cap stocks have had several attempted rallies this year, and actually over the last 18 months, and every one of them lasts a couple of weeks, maybe 4 or 5 weeks, and then they fizzle and they reverse. And they're in a long, if 18 months, almost 2 years of a trading range. let me out of here,
Right.
let me out of here. I'm going to climb this wall of worry. Oh, I didn't have enough fuel to make it all the way up.
And
Investors
there's
are
still,
very,
yep, there's still plenty of people, investors, like I say, now that's buy the dip. Look at how depressed this price is. This has got to be a good buy. It's got to be, right? No, not not yet, not yet. But the narrative is saying yes, you really should get in there and buy those, because small cap, traditionally, it's going to lead us out of a bad market. Those small caps are going to get the biggest bump. But like you said, Don, every time they try to make a run these days, it collapses, and all the money ends up getting sucked up by the top end, by the huge corporations at the top, and that's the nature of the market right now.
well, so as you mentioned, the seven have dominated the NASDAQ, the NASDAQ 100, and they have heavy influence in the S&P 500. But if we look at a technology index fund, the XLK from Spider,
Yes. Yep.
that is dominated by two stocks. And roughly 45% of that portfolio is Microsoft and Apple. If you want to get to 50% exposure, you add a little bit of NVIDIA. The rest of it doesn't matter. That's concentration when you have two
Correct.
stocks, 45% of your portfolio. It also means your downside risk is really dependent upon what happens to those two. Now, Apple's had some real trouble, particularly in China of late. Their iPhone sales have been um, overcome by a China competitor. Chinese people are buying a homegrown, brand new iPhone competitor, and Apple is losing ground over there. That's a real stumbling block for Apple.
What do you bet it looks a whole lot like an iPhone?
And the name of their company slips my mind right now, but they just kind of took that for granted that that company was Chinese stolen technology. Actually, they developed their own chip, which was faster than Apple's. But you're right, it looks an awful
About
lot
that,
like an iPhone, but it's
right?
faster and it's homegrown. In here we'd say made in America. Well, they're saying
Right.
made in China. And then
Not
you
made in
turn around,
America. Yeah.
not made in America. Then you look at the other leader in XLK, and that's Microsoft. Well, one of the whole things that's driven technology this year is artificial intelligence. Well, and the Chat GPT was developed and released to the public by OpenAI. Well,
Correct. Yeah.
OpenAI's board has made some bad decisions. They kicked out the creator, the co-founder of the company, who happened to have been hired by, I don't know if he's hired or he's bought by Microsoft.
Either way, yeah.
Either way. So the president and the co-founder of OpenAI are now at Microsoft, and the remaining employees over there, there's 500 of them that were in Monday's news saying the board either quits or all of us are going to Microsoft. Well, Microsoft has managed to reverse negative opinion in the marketplace from about 5 years ago, where Google was the dominant leader in virtually anything on the internet. Microsoft was clearly second place or third, and now they're number one. Their advance in the application of AI in their product, in their cloud, in their user base has given them an extra $1 trillion of market value above Google. Who'd have thunk it 5 years ago
Yeah.
that that was going to be the case? And
That's
now
amazing.
they basically are going to own the creator of AI, well, at least of the open AI and its application in broad sectors. And
Right.
that's actually part of the driver of the market as we look at the next 5 to 10 years. You think of AI and you think of technology, but the real benefit of AI is going to be the application of it in production, in assembly lines, in
Yep.
in ideas. Well, that was one of the reasons for the recent strike of the Actors Guild, is they wanted some way to get compensated as AI replaces some of their work. So this is a game changer, but how it's going to play out and who the eventual winners are, we really don't know. Microsoft, for the time being, certainly has control of the reins.
We're certainly in the rich are still getting richer part of this business cycle. And Microsoft and Apple, just those two companies, they're 15% of the entire S&P 500. So just those two firms are giant and getting bigger, and they have more control actually than ever in the top end of the S&P 500. There's been times where we've had high concentrations. The last time we had high concentration, it was energy companies. It was Exxon and Shell and the huge oil companies that were in charge of the largest companies. Those companies aren't even on the list anymore at the top end. Everything's been supplanted by the mega cap technology companies, and that's a significant shift. And it's going to continue in that direction. Like you said, Don, every time the tech market begins to slow down a little bit, that next thing comes along. And right when they needed it, the internet really came online and changed everything. It changed personal communication. It changed the way business worked. It changed the way governments work. It changed the way the supply chain works. And now we're going to get AI coming in there. And all corporations and all technology companies are realizing that like you said, AI is going to change everything as far as production of anything goes, and that includes intellectual production, intellectual property, as well as physically producing goods. It's going to change everything. And here's Microsoft sitting in the catbird seat, already completely aligned with GPT, and now they're going to end up with one of the founders working for them, and apparently a large percentage of the employee base is ready to go with them. So right now, you almost need to be a mega cap company to be able to support a platform that is changing things so much. You need that size to make it happen. And even companies the size of Apple and Microsoft are being disruptive to the market in general. Never seen that before. Usually the disruption comes from those smaller companies coming online, and between the large companies buying up the small ones and those large companies ending up bringing some of that technology to the public. They're very disruptive at this point, and with the size they have, they can afford to be, because they don't have to have everything be in a winner. One thing not quite being as big as they thought is not going to sink $1 trillion corporation. So they can actually take a little more risk and put more things out there, and it allows them to be more flexible. And that's going to happen until they get leapfrogged, and they will. Something else is going to come along. And there is a disruptive technology that we haven't thought of yet, and it's gonna come a long line out there and blow some industry right out of the water. It's very exciting to watch that happen. That's called creative destruction. It's part of what makes free markets work, and it's pretty exciting to be on the front end of something that big. So we get to watch it happen. That's pretty exciting.
Creative destruction routine in the economy. It happens in a free economy. It doesn't happen very often in a controlled economy. But that's correct. One of the reasons people keep looking at small cap stocks, because traditionally they are the ones that come up with the new idea. They have access to funding, which in the current environment is very difficult for them to raise. The banks are much more restrictive. The interest cost is much higher. The IPO success has been abysmal over the last couple of years, so it's hard to even find a venture capitalist, much harder now than it was pre-pandemic. So the competition that we would normally see coming up out of these smaller firms is a little bit more difficult to locate, and whether or not it's going to survive the mega dollars that are available with the current leaders, it's going to be a harder game. And people get an idea. I refer to it as thematic investing. Thematic investing would be investing in AI and trying to find the small cap company that's going to benefit from that. And the odds of actually being a winner doing that are not in your favor, are they, Perry?
Not at all. Not at all. The vast majority of individual securities versus the market are losers. It's a little over 90%. If you're looking at 10-year returns, you can find small companies that have that quick burst. They're going to break onto the market. Everyone's going to be believing the narrative, like you said, Don, the theme of their story, and they're going to buy them up, but they're not going to have any legs. They're not going to be able to keep that going, and they disappear. So over even 5-year periods of time, those individual stocks are really hard to find a security that's going to be even better than the market in general because of the huge cap weighting at the top of the market right now. It's really swimming upstream all the time for those companies, and they just can't stay afloat. They're going to have somebody come in and buy them and bring their technology to the market because, like you said, technology companies in particular run on low interest rates. That's how they expand. And unless you have a lot of money on your own, look at the Magnificent Seven. That's who's sitting on a pile of cash to do those kinds of things. It's very, very costly now to borrow that money. So it's really tough for those up and coming companies, even if they have a great idea, to bring that stuff to market right now.
So when we go back to the zero interest rates during COVID, what we had were these big mega companies borrowing money for 30 years at 2.5%.
Correct.
Hundreds of millions of dollars. That's the cash that they have. They don't need to go out and borrow a ton of new money to start a new enterprise because they're sitting on cheap dollars right now. And it gives them some money to resume stock buybacks. And there is a new surge in stock buybacks that looks like it's starting as we move into next year. But as individual investors, there's a high risk associated with buying individual stocks that requires a lot more research than it has in the past. And it's one of the reasons our portfolios are built around exchange traded funds. We know we're not going to end up with that one stock that provides a 1900% return over the last 15 years or 20 sometimes. But it does provide diversification. So instead of worrying about, do we have the best healthcare company, or should we be in Microsoft, Apple, and NVIDIA and not be able to afford anything else? The ETFs break up that single stock risk with diversification, owning major tech companies, broad exposure to health, and other sectors that we may be invested in from time to time.
Right. And if you're an individual investor, that concentrated position in a few single stocks can just kill your portfolio, because no matter what that company is, they can take a big hit. Doesn't matter how big, doesn't matter how strong, doesn't matter how historically successful, they can take a big hit. And that is transferred directly to your bottom line if you're just holding that one security. That's why we get rid of that individual stock risk by buying the ETFs. We want to own more than one.
If you want more information, give us a call, send us an email. If you haven't already, subscribe, use the button down below, subscribe to our podcast. And that'll be a wrap for today.